Hello, everyone. Thank you for joining us today. My name is Adina, and it's my pleasure to welcome you to the Tech23 Impact Circles. It's wonderful to have you all join us for what's sure to be a great conversation exploring Investor Connect, preparing for a Series A in the D-Band. As is custom, I would first like to acknowledge both the Gadigal people of the Eora Nation and the Bunwurrung and Wurrung Wurundjeri peoples of the Kulin Nation, the traditional custodians of the land where the Slatterys team meets, works, and creates. We pay our respects to the elders both past, present, and emerging. We also acknowledge that people are attending today from other traditional lands and nations, and we extend our respects to their custodians, ancestors, elders, and future leaders. Always was, always will be Aboriginal land. Hi, Rachel. Nice to see you here.
Hi, Adina. And it's lovely to be having this Monday Tech23 Impact Circle. I want to welcome everyone onto the line, and especially to our contributors today, Natasha, Ellen, Tip, Phil, and led by the very able Colette. One of the best things we've found about Zooming in is the ability to reach people from wherever they are. So please say hello, introduce yourselves on the chat, and maybe tell us where you're Zooming in from, what Indigenous or traditional lands you're currently working or sharing from. Tech23 is all about amplifying the people and the organisations chipping away at the biggest challenges we face. So this year, in the very special 2020, we've been coming to you any which way. We're looking forward to 2 days' time to amplifying 23 young companies with great potential for the 12th year. So stay tuned as we reveal those 23 young innovative companies. We're also looking forward to seeing people face-to-face on Thursday for the long lunch. I'm very excited about that, Adina. But none of this could be possible without the support of the Tech23 sponsors, Oz Industry, UNSW, Main Sequence Ventures with CSIRO, the New South Wales Government, Macquarie, Addison's, Ansto, Cicada Innovations. And I want to also shout out AWS for their help this year with the AI Conclave. Without all of these sponsors, we couldn't make Tech23 happen this year. Again, a warm welcome to all of you on the line. Please ask your questions on the Zoom chat or privately to me and Adina if you like. You can share on the mural board, and after we've eavesdropped on what I think will be a really wonderful conversation, we will then have the opportunity to ask our questions and also break into small groups. Back to you, Adina.
Thank you, Rachel. Just a couple of little housekeeping things. You will have seen in your reminder and now in the Zoom chat, there is a link to the Slatterys Community Charter, which is a great read if you need guidance on the behaviour that's encouraged at the circles. Now, just to confirm the running order today, we'll be starting off with Colette and the contributors kicking off the conversation, followed by Q&A from all of you. And if time permits, we'll finish with some randomized deep dive breakout rooms. Now, we are using a shared mural board to capture your thoughts, which we are sharing now in the chat. Please feel free to add whatever you like, your burning questions, squiggles, stickies, to this board at your leisure. And as Rachel mentioned, please do chat any questions to us via Zoom to either privately or up front. Now, we will be recording this presentation so you can make it available post-event so you can revisit a bit later on. Now, as Rachel mentioned, we extend our heartfelt gratitude to every one of the Circle contributors and all of the Tech23 sponsors and supporters for helping to make today's session come into being. We also want to thank all of you for dialing in. Now, without any further ado, I'd like to hand over to Colette to kick things off. Thank you, Colette.
Awesome. Thanks, Adina. Thanks, Rachel. And hi, everybody. Thanks very much for joining us. The objective of having these circles is to really dig a little bit deeper and make sure that we actually ask questions that we probably wouldn't ask on a conference stage. So I'm going to put a couple of my fellow conversationalists on the spot, and I'm just going to ask, hands up, everybody, if you're actually wearing pajama pants under there. Yeah. All right, Phil's still in pajama pants. Awesome. So this is actually relevant because, when you're starting a company and you, especially if you're doing your first startup, when you're going into your first ever funding round and you're looking for money to give you a little bit more runway so you can make it come to life. Oftentimes the first time is a bit like wearing pajamas underneath, you know, you're sort of like you're pitching really professionally up here, but you have no idea what you're actually doing. And then you get to something that's called a Series A, and that sounds serious. So is a Series A purely a label? Is it actually different than a seed? Like, what makes it different? Like, what is it? And what makes it different from everything that you've done before? Maybe like anybody, just jump in.
I think in many ways it is just a label. Let's start there. But I think historically a Series A has been the first major institutional capital raising, which is fueling a company with clear evidence of growth. I think that is slightly different in deep tech, and maybe we'll get into that a little bit later, because deep tech has a different sort of life cycle with a lot more heavy lifting at the beginning, but then perhaps more simple to distribute later on. But I think for me, one of the things I've learned actually as a VC this year, helping our portfolio to raise money, has been that the label can be quite damaging, because investors have a series of principles about what they invest in and what they don't invest in. And you'll hear people say, well, I only invest at seed stage, or I only invest at Series B and onwards. And the problem is, you can say, I'm raising my Series A, and people go, well, I can't invest in you then. And you go, oh, actually, maybe it's not a Series A, maybe it's actually a late seed or a seed plus, and all these conversations happen. So I in general try not to label rounds now for that reason, because it allows a conversation to occur, and then you can kind of figure that out between actually what the fund wants to see in terms of progress and where you're up to it as a founder. My final point on that is, I would say that Series A, different investors measure what a Series A is differently. So again, you may pitch to one investor and say, I'm raising a Series A, and here's my performance as a company. And they go, great, that's fantastic, and I want to see more of this. And you go, great, I've done it. And then you go and pitch that over to investor B, and they have an entirely different view of what a Series A is. And that's all compounded with the investor world just the goalposts are just moving outwards throughout constantly. So it is a label. It's kind of worth understanding everything we're going to talk about today, but it's just a label.
Yeah, Natasha, do you reckon it's helpful for people to have that label, or counterproductive?
Yeah, I think when Phil said that when we were having the pre-chat, I sort of agreed, and we call things funny raises funny things in Uniseed anyway, and I'm probably glad we did that, because people can't label them. If you call yourself a Series A and you're actually quite early, it can be detrimental to the raise.
In which ways?
Well, people just sort of see you, and they'll be like, well, you don't have the traction for a Series A, or you don't have this for a Series A. And so it sort of positions you, and seed investors might not be interested in you when they should be, because it's actually the right thing for them. So, for example, when we were raising for Foresight last, we were very careful not to call it a Series A, because it just positioned it incorrectly for the investor community overseas. So you've got to sort of think about where your money is coming from, what they're used to labeling things for. And so at the end of the day, it might be best not to have a label and just call it, growth seed, or, or something like that.
So do you literally just make up different titles? And you go, it's a growth round.
Much.
It's the time,
or A, or whatever.
That time we expanded to the US round.
We've got one company this year that did a pre-seed, then a seed, then a seed plus, then a seed plus two.
Funny thing is that Canva's still a Series A, technically Series A5 or whatever it is. So it doesn't really mean anything if you're a $5 billion company anyway. So
it means nothing, and you can be a bit creative.
Yeah, and Tip, I know you guys at Blackbird are, you've got a philosophy around investing in exceptional founders, so the round itself is less relevant for you. But how do you think about a Series A? Is that, is that actually still something that you classify?
Yeah, we do. And I think just looking at the deep tech companies that we've invested in, and it's more around the milestones that we expect them to have reached by the time they raise Series A. And to Phil's point around evidence of growth, there are certain buckets that we do look at as well. So just looking at the kind of the common themes for deep tech Series A for us, there's unit economics and making sure it's heading the right direction. There's evidence of customer love, strengthening in the moat around the product and go to market. There's building on the momentum of seed and also just the ability to scale. So with seed, you're kind of looking for evidence of customer love, finding your niche, and with Series A, you've found something. It's kind of like that analogy of firing bullets and then kind of knowing where you're aiming. And once you hear that ting, you aim that cannonball. And the Series A is really around scaling. And I think one thing that a lot of founders the great founders show a really deep understanding of is actually in customer love and showing that when they build something, people will buy, especially with deep tech. There's a very long cycle sometimes when it goes to market. So really understanding what customer love looks like. And I find that it tends to come in the form of four things. And the first thing is around embedding the product in the workflow or routine, which tends to be a permanent change for customers, and it's really expensive to revert back. So for example, for a company called C-Mode, the sonographers now use C-Mode's product as part of their sonographer workflow. So that's really expensive to revert back and change that workflow. Or another example is Guzman Gomez has retrofitted their whole production line to include the flavoring component for Fable, which is mushroom meat. And so again, reversing that change would be really expensive. So it really just shows the customer's conviction in the product and wanting to invest to actually embed that product in the workflow. And the other three examples of customer love is really around expansion and upgraded revenue. So the product has made an impact in a different facet of the customer's life. And so they're adopting new features. And the third one is around word of mouth. So sharing with the community, or there's a strong sense of advocacy from the customer, pushing it out there to the community. And the last point is around high user activity. So we care less about kind of the top line numbers, like how many downloads there is or how many downloads a white paper gets, but really understanding how often do users jump on the platform, use the platform, how many hours a day. That's really much more important.
Wow.
Do you look at those things differently for deep tech at Blackbird? So Baraha or Gilmore, obviously sort of users using it every day is not going to be happening that much, right?
Yeah, absolutely. Yeah. So with Baraha, for example, there are certain customers, like tier 1 customers, that they have to get. And so talking to the customers, seeing where that fits into their production or their product pipeline as it's a part of the component is really important. So it'll be more of a sit down, referencing your customer, talking and seeing if they're excited about actually, putting it into their pipeline, or they've signed some sort of letters of agreement. So it's around kind of like committed the money to help them have an end product.
I might add to that, if that's right, because I think that's a really interesting tip, because I think we probably do a very similar thing, but use different language. I think we tend to use a risk as our tool to evaluate. So a couple of categories of risk we look at is technical risk, commercial risk, and execution risk. So that technical risk is all around, especially in the deep tech space. Does the technology, is it outstanding technology relative to what's out there, and does it, is it likely to work? And that'll be the thing that you spend most of your early money on in deep tech world. And then commercial risk, just similar to your customer love metric, I guess, is, do people actually want what you've built? And then execution risk, can you scale it and take it to market? And I think, to your point, Phil, I think the thing that that you spend most of your time on in deep tech, that's probably different from the more tech light business, if you like, or software or SaaS business, is that technical risk and commercial risk is trying to address those, and that execution risk probably comes a little bit later, because it just takes that much longer to kind of get the other two under control before you sort of then, and that's where that Series A moves around as well. If you're saying Series A comes in when you've got kind of your technology risk at least under control, and you've got an understanding of your commercial proposition, how you're going to take it to market, then that Series A comes into scale. And that might be a few years further down the track than a traditional sales business, for example.
Yeah. Ellen, you've had so much experience with commercializing deep tech, previously with Cyro and now at IP. And like, in the absence of having, you know, the cycles for development are so much longer than what you just mentioned, you know, with the SaaS or a software-based business where you just like iterate and learn and iterate and learn. And we're very proud of the iteration cycle. But when you're in that early stage and you're doing a lot of that technical validation and reducing the technical risk, what are some of the things that you think from an investor's point of view that they're adding into the discussion? So what would make it attractive for a company at that point to have an investor on board?
So I think it's a good question, actually, because I think, and I think historically we can look at this in the commercialization, sort of where money is spent along the way, and people often sort of want to throw more money at R&D, thinking that will result in more outcomes. And I think the thing to understand is that a lot of scientists and researchers, and I'm going to generalize here, because you kind of have to make a comment. Of course, not everybody falls in this bucket, but tend to be more curiosity driven. And the more money you put into R&D and science, the more science and R&D outputs you get. It doesn't necessarily translate to commercialization. You've got to have a crossover with commercial people, and commercial people actually at some level trying to drive the bus to say, stop doing all that science and R&D. Let's stick with this particular concept, and let's see if we can actually make it work, and make it work out in the field, and make it robust enough, or large enough, or small enough, or whatever that has to happen to make it actually be applicable in the real world. And I think if you just, in general, leave that just to the scientists and technologists, you won't get that outcome. You really need to have that blend of skill set to kind of get it to that commercial level. And somebody's got to have their eye on the dollars and cents all the time, not just from a budget perspective, from a what cost, where do we, it's nice that we've got this new product or new technology, but where does it need to be in terms of where the market is in order to be adopted? Because there's a lot of great ways to do things, new technology ways to do things, but unless they're actually going to be cheaper, better, faster, or have some commercial benefit, they're unlikely to be adopted. And I think it's that blend of skill sets and people that will bring about that commercialization outcome. And that's, I think, yeah, where often many researchers might need to focus on getting some commercial people on board. And that's where I think investors can really help to drive that, because whilst we love technology at IP Group, we're also, investing other people's money. So our focus is very much on how can that technology get into the marketplace and make a difference. And that often comes down to economics.
I thought Phil was itching to say something.
I'm always itching to say something. I want to celebrate Tip's comment on hearing the ding and then firing the cannonball. I'm going to use that every day now. I think that's fantastic. And that's sort of one of the two things which I just want to expand upon Ellen's description then of a Series A, which I thought was spot on, that there's two things. There's the technology risk and there's the market risk. And in deep tech, the technology risk is usually deeper. It's sort of harder to prove. And so we need to spend more time there. So I think the question before doing a Series A with a deep tech is, when you show people what you've done, do they believe that you can do it in a much bigger way at that point? And I also agree with Ellen that deep tech companies naturally tend to not spend enough time on the market proof, the market ding, if you like, going back to Tip's sort of analogy. And this is critical. I think in my experience, the difference in valuation and confidence behind a Series A round that has both technology proof and market evidence that if it did get Series A funding, it could really go. I think that's really important, and it's the most under exercised muscle in deep tech, I think, in the market today.
Tash, I'm really keen to hear what you want to add to this.
I echo everyone. For me, I mean, I'm a visual person, and I think of pictures. So, for me, it's like a cake that's almost cooked Series A. It's still a bit soft and runny in the middle, but the outer edges are beginning to be formed. And that's in every part of the business in terms of tech is being de-risked, and the market is being de-risked as well. And I'd like to call out Debbie Saunders on the call today from Wildlife Drones. So we invested in her, and to echo Phil's point, I'm pointing there, I don't know where he is on your screen, but, you know, she had, 150 odd thousand worth of customer orders sitting there that she couldn't actually fulfill because she needed the money to build them and develop that next lot of tech. Now that was such great market proof. And I think deep tech founders actually get a bit lazy sometimes. They don't think that they can get the customer proof points, but actually they can. I know I can when I'm looking around the place and calling up customers when I'm doing, looking deeply into companies. So I'm pretty sure that they can do it as well. So the customer proof actually is more important than the technology quite often, because it will take more time and more money than the original invention to get it to market. So it's absolutely core to having a business that investors like us can invest in, because we don't invest in inventions, we invest in businesses at the end of the day that can sell and make us money.
That's so true. I just want to add to that. Michael Becker actually said a really good quote about from StartMate, where he said that your starting point is your customers, not the product. And so really, I'm reading the chat and people are talking about commercialization and product. They're all in one thing. If you're a product founder and you're building a business, the customers really come first and kind of not the afterthought. And a good example of that is Beyond Ag. And what they do is they raise black soldier flies to eat waste, and then they turn that black soldier fly and waste into pet food. And they can, a lot of, I guess, deep tech founders would say that you need to build out a facility and then kind of create the product and then line up the customers and then sell to the customers, but you need the money to build the facilities first. But what they did was just use basic boxes to create like a very small MVP, and created the pet food version and sold it to some overseas investors who are buying pet food for their hawk or something, and just showed that they could at least make one transaction out of that product and sell it. And so for them, they had customers first, and then they had that validation before they even started raising their seed. And then their seed became about raising to create a pilot, and then a little pilot facility where they can have a couple more customers on board, and then use that customer funding as well as a seed round to expand as well. And to Phil's point around Series A is for doing bigger things. I think the biggest thing at the risk that Ellen mentioned as well around execution is the ability to scale, and especially for hardware and frontier tech, Series A is really the beginning of scaling. And usually you have your product, which you have your pilot, which is the validation point, and then you're raising to go, I guess, commercial scale, and that's going from lab or pilot factory or your garage or whatever it is to a larger facility. And at that stage, when you're sitting in front of investors, they ask you kind of 4 rough questions: is what are the sequence of events that you need in order to facilitate that scales? Like, you need to be able to clearly articulate, this is what I'm doing, and this is what I'm raising for, and these are the sequence of events that needs to happen. And then articulate how that unit economics change. So whether it's the quantity of output or customer demands you can now meet, or cost, or whatever it is, really clearly articulating how that changes from seed to Series A, making that less ugly, because initially upfront costs can be really big and ugly, and seed investors are really fine with that. But as you scale to Series A, really understanding how that levers for economies of scale changes, and then really understanding the resources you're investing in from the funds from this round. And so it's not enough to say, I'm going to raise a 2 mil round because that's a seed or Series A round. It's, why do you need to raise that 2 mil round? What are you going to spend it on? The people that you're hiring, the output that you expect from this for Series B, and having that milestones of Series B already in your head. And the most important part for Series A is, it's not good enough now for you guys to have a bunch of assumptions. You need to now have assumptions plus learnings. So you're really building on the learnings from your seed. And so really identifying your Series A assumptions, and that's where your biggest blind spots are when you're scaling.
Yeah, I will just go on from Tip. What really can frustrate me when I'm looking at businesses at this level is that the CEOs don't know their numbers. So I think it's really important that you really understand all the key levers for your business. You know, it's unit economics, but it also might be around your customer pipe and how you're converting, when you're converting. You know, so when I look at the revenue numbers, I can really understand the main assumptions under that. And it always surprises me how like little those numbers come to people's minds when they're called on. Just, you know, refresh before you go into, you know, your investor meeting or have a cheat sheet. I mean, I certainly did that in corporate where you're hammered on numbers all the time. So just make sure that they're ready to hand and you look confident with them when you're talking about them.
Can I just lob in a sort of contrarian view on Series A's? So in deep tech, I think Series A companies rarely, I think I'm safe to say rarely, have unit economics. You know, if you're
but you could fill around output or the cost.
Right.
Of
True.
That's what I mean.
True.
So you're aiming for a manufactured ready model. So that's what I mean by unit economics. There's some sort of product cost in there that you're trying to reach. You might not have a revenue and all of that sort of thing yet, but you got half the ecoation. Just
that's right. Yeah, that's right. So you need to know how this whole business is going to work. What are the unit economics of the product, etc. I think one thing that's really interesting about a Series A, in my experience, is that it's really important to get the valuation right, and actually to try and get the highest possible valuation. Because another thing in common from most deep tech companies is that the capex usually is enormous as you're starting to scale the company, and you need to build rockets or solar farms or hydrogen storage facilities or whatever it is. You need a lot of money, and you need to do that in such a way that you just don't wipe out the founders with investor money on the Series A. So it's important to design the Series A to have the maximum impact for the company's cap table.
So question then for you, Phil, following on from that, it sounds like when I asked earlier around the additional value that a VC or an investor can bring is really understanding that capital strategy and understanding, you know, the operational delivery of what needs to happen, capital strategy. How do you do that as an investor with the founder's best interest? Yeah,
well, I guess once you've invested, you're aligned, right? We all want our ownership in the company to go up. Investors do this really well, and I think it's one of the sort of great undescribed areas of investor activity. I think we all spend a lot of time meeting our peers all over the world. I think especially in deep tech, there are reasonably small sub-communities of investors who are investing in similar things. And we spend an awful lot of time on calls with them, spending time with them, understanding what their investment thesis is, understanding who the customers are and who are the companies that we might partner with. And certainly when we invest in a company, we know, at least as a hypothesis, what the next round looks like. We know who's investing, why they want to invest it, what kind of valuation we might expect or we should aim for as a target. Bill Barty calls it the slam dunk financing that we use quite a lot. And that's what we're aiming to deliver in partnership with the company. So it's massively important in venture that venture capital and the companies that are funded by venture capital fall to pieces when the company doesn't step change in value upwards. That is the fuel that makes the whole thing work. And if it flounders its way around, the momentum behind the company struggles. So actually designing what we're all doing so that that valuation goes up and for everyone to be on the same page is critical. It's much more than just building a great company. It's doing it in mind with your capital raising.
I guess that's why like higher valuation is also a double-edged sword, because if you're raising a really high valuation for Series A and you don't meet the milestones that you've set, then it's most likely going to be a down round, which isn't a great thing. So just keeping in mind that, you know, valuation should reflect that, you know, a certain dilution from the founders, and at Series A, we still want founders to hold the majority of shareholding, so 60% upwards. Is ideal, and also how much you're raising, and also reflecting if you've got a lead investor, how much ownership they typically need in a company. So for Blackbird, we're typically looking for 15 to 25% ownership. So kind of all those three factors do factor into what the valuation should be.
I just want to jump into a question from Michael Harvey, which is related to this. Do you think we will see more early funding rounds unpriced, so say for ASAs, etc., and Series A becoming the first pricing event?
If I can answer that from our perspective, especially in the deep tech side, I think this is sometimes just kicking the can down the road. It's sometimes just, I think, unhelpful when people just have really high expectations of valuation when there is, again, as I said before, back to the risk framework, a ton of technical risk, a ton of commercial risk, and a ton of execution risk to still. My personal view is that it's sometimes better to just, you know, bite the bullet early, and certainly this is how we work, and we partnership, and we build value together, and we'll make sure that founders and you know, people along the way are adequately compensated one way or another, either, as Tip said, by ensuring that, you know, the percentages make sense at the Series A or later, or else, you know, via options or other mechanisms. I think it's just a way of just get the money and get on with it. Back to the earlier point, you can, especially if you're very science-led and science-heavy, you can go around in circles a lot for a long time without the commercial leadership that's actually going to drive you to your next valuation inflection. So you may as well sort of, you know, take the right kind of money with the right kind of people and go up, go forward. I'm not a huge fan of safes and those sorts of things. They just kick a whole lot of key questions down the road that you still got to solve.
For us, we, you know, because the first investors, because, well, with Ellen and ourselves, we're often the first checks in you know, a pretty scary, risky space. We like to price it to reduce our risk. However, after that, convertible notes are not uncommon. Especially if the company, you know, especially what we've seen with COVID, just needs money for things outside of its control. It's a really quick way to get money into the business, and there's some really good upside for us as investors. But, you know, we can't keep doing convertible notes forever. At some point, there's got to be a priced round.
Yeah, we always do priced, and when we don't do priced, it's because it's usually an internal round, and we're trying to play a part in getting the company ready for a big round that somebody else is going to lead next, and we don't want to go forward into that round with you know, a not quite complete state of readiness, right? So let's make sure it's properly funded, that the evidence is all there, and then make sure that next round is great. But I don't see many safe and convertible notes in my work.
Lucky. Hey, I wanted to follow on a little bit and think a bit about more of IP. So if you're looking at an investment and you're trying to do full due diligence on that company, and you're talking about something like deep tech, which is, you know, inherently sitting all around the IP, what is the best way to approach, you know, that situation where on one side you've got a startup founder who doesn't, or a researcher who doesn't or can't divulge everything, and you've got an investor that needs to know everything in order for the next step to happen? Like, how does that dance work? I might kick that one over to Ellen.
Yeah, I think I expressed some views on this in the pre-chat, but yeah, I think I've come across a few founders that sort of seem to treat the whole thing as a bit transactional. Sort of like, I'll show you what you need to know in order for you to buy, and just give me your money and I'll you know, go forward. Just doesn't really work that way. It's kind of like
Tinder,
a marriage, or
Tinder
possibly
for
worse.
investing.
Sorry?
Yeah, it's like Tinder instead of a marriage.
Yeah, exactly. It's like, you know, we're in this together. Like I said, we come in early, we go the whole ride. When I'm assessing an investment, I'm not looking at it for just the Series A or the seed. I'm looking at it for until we, you know, absolutely blast the exit out of the, you know, stratosphere. So that's where I'm going. I'm not, you know, so I need to know everything. I need to know everything, including the bad stuff, because I need to understand risk. We can invest in lots of things, but I need to be able to present, here's why I think it's a really great idea, here's the market and the opportunity, and here's where the risks are. So that way we can allocate our capital to the right things and make sure that we mitigate those risks and we maximize the kind of opportunity and the road to success. And if I don't understand all those things, if I'm not in the tent, let in the tent, then I can't represent the opportunity appropriately at the investment committee. And the way it works in our shop is that it just doesn't ever get there. It doesn't get to the investment committee. We can't take it forward. So yeah, so if you kind of want to go forward, we have to know everything, good, bad, and ugly, so that we can make a proper informed assessment. And then we'll always feed back, you know, around that if we decide not to take it forward for different reasons. Like, for example, we think the technical risk is too high, or we need to see certain further metrics before we can take it forward, or we, you know, we think the opportunity is great, but it's, you know, not for us, and therefore we'll make introductions to other people. You know, we will try to help. We're not there to sort of suck out all the information and go, oh, great, no, sorry, not for us. We will try to help and take it forward, but we can't be drip-fed information or be sort of like, you know, yeah, not let fully into the tent.
What's a good, I suppose, like just practically speaking, if there are founders who are in that space and looking to raise, like practically speaking, what's a good way to approach this with an investor? Like, Tasha, I'm imagining you've seen that lots with Uniseed as well.
Yeah, I think, well, I mean, just on the patent thing, I mean, most of them come through the university. We have an NDA with the university, so that's all covered there. We will, you know, we do quite a lot of work on the patents if it's necessary, you know, freedom to operate, that sort of thing as well, not just whether it's a novel idea and protected that way. And, you know, we always have, I think, are you going to sort of the investment committee question there? Sorry, Colette, or not really yet?
I was more curious. Well, I was curious that there's two ways, right? So there's the difference between how you approach the investment committee and how you would approach the partners, and the necessity to actually work transparently all the way through, which I think is worth giving advice to.
Yeah. Okay. Sorry, I got a bit sidetracked there. Look, the way I see it now having been a founder and now an investor, is that you have to find a VC on a team who is going to be your absolute champion. You know, like you have to enter in a marriage together. You've got to walk through fire together. And the thing is that, you know, I'm quite an optimistic person, but I've noticed in VC, they're the most sort of pessimistic, realistic, cynical bunch of people you're ever about to meet. And I work with a team like that. And so when I see something that I like, I have to really go into bat for that business and know that business sometimes, or that invention, better than the founders do, because I've got to come up against all the hard questions from my team before we even put it in front of the investment committee, which is another 6 or so people. So I've got 10 people to get across the line for every single investment. And that takes a lot of politicking, to be honest with you. Like, I've got to think about who in my team I've got to work up before I even bring it to the investment committee, so that when it goes in front of the investment committee, I know the questions that they're going to get. I'll prepare the founder for the questions. You know, so you work as a real team. And even if you do all of that work, it doesn't mean the investment's going to, you know, get across. You know, there's things that I've absolutely believed in and taken to the investment committee and worked hard on, and they haven't got across for whatever reason. So, but you need, you know, you need to, like Ellen was saying, to expose everything, because we're going to get all of those questions, and really take it on as a partnership. And you've got to feel that energy from the VC that you're working with, because they've got to really do most of the driving of the deal through with the team.
Do you all have to agree, Natasha? on your IC?
Mostly. There will always be people who disagree for sure, and that's the same with our board, but it's just got to sort of be majority, and that you've addressed the red flags enough, because there'll always be red flags. But it's a really good question, because it doesn't always work like that, does it?
No.
So if NDAs are useless and founders still need to protect their IP as part of this discussion, how do they do that?
So maybe I can add a little bit from my IP group perspective. We do come in very early. We do look at very deep tech. So we will sign NDAs at an appropriate time. We have, as Natasha said, NDA protection with the university. So because we often see things pre-filing. And I think when you haven't yet filed your IP, I mean, it's unrealistic to expect founders to disclose that. And obviously it compromises potential down the track. So we will sign NDAs, basic NDAs, our NDA ideally. We're not going to negotiate an NDA for 3 weeks because that has happened before. But we'll sign basic NDAs if it gives people comfort ahead of filing it, et cetera. And we have those basic protections in place with the universities. But we generally won't sign NDAs until we're kind of, if we need to at all, until we're at the quite serious end. And we will try to kind of not do it because it's kind of unhelpful most of the time, just gets in the way. With regard to software type ideas, again, I think they may not file, but again, I just think you just need to be realistic about, you've just got to be able to talk about your idea. I mean, you can keep everything a secret forever and nobody will ever invest in it, and that's fine. Or if you want investment, you have to kind of let people into the tent and go forward.
Isn't it just a question of timing? I think the reality is, investors don't sign an NDA for you to come and pitch to them, right? And because we just see so many, but we nearly always sign an NDA where we need to go deep into what the IP is. I mean, that's perfectly reasonable for all the reasons that Ellen said.
So thinking about that time when a startup does come and approach you, when in their journey is it a good time, and what's a good opening conversation? Like where's the starting point for them?
I think for us, as early as possible is good before you raise. Not because you're starting conversation to raise early, but just for us to be able to build that relationship and see your ability to execute over that time before you raise, so that it's not like we're ready to raise, we're closing in 5 weeks, I've never met you, let's start the relationship. So I think a typical relationship is 6 months to 12 months before raising, getting to know each other and keeping us in the loop of what you're doing and the milestones before the raise, so that we can hold you accountable to, did you do what you said you would do? And that's a great indicator of you're a founder of execution and more likely to build conviction and back you in that round.
Yeah, I second that tip. Talking to people before you raise, talk to people before you need the money. Come across a lot of founders and teams that will only talk to investors when it's time to raise, and it's back to that transactional relationship. Just here's my pitch, give me your money. I'd much rather have a coffee with you way before that, and you tell me a bit about your idea and what you're doing and what milestones you're aiming to hit, and then come back later and say, oh, by the way, we had a coffee a couple of months ago and I told you about blah blah blah. Well, here's what we've done since then, and here's where we're going, and by the way, we'll be raising our Series A in a few months. Can we come and pitch to you guys? I mean, that's just a far better approach, I think, than just waiting till it's all cooked and you've got your deck ready and it all becomes very very pitchy, very it heightens the bar in due diligence if we've got to start from scratch. And I guess that's what you're saying.
So it sounds like every investor, and this shouldn't be a surprise, but everybody wants to be first check in. So let's maybe talk about that transition between when have you invested in sort of the first round and then had to follow on in the Series A, and what are some of the considerations for you as an investor, but also what do you think founders should think about in terms of having follow on from their existing investors versus including new investors? I'm just going to keep trying until I find the question that stumps the, the panel.
Well, I don't know, Phil. Do you want to go first, and then I'll follow?
All right. So we like to do first check. Usually, it's because we've spent a lot of time with the team. You know, my answer to the last question is sometimes we've been working with the founders for 4 years before we invest, and that's not because it takes 4 years to get money from us. It's because we've just developed a deep relationship with people over time when the idea was just a thought inside a lab somewhere, or it may have been a prior thought, and we've just worked with the founders on how they think and what they're trying to do and how they might solve certain problems, and there's just been an ongoing conversation, and that's why we tend to lead with the first check, because we've got 4 years worth of conviction when we actually take a punt, and we know that they're going to have a damn good crack at it and they've got the best chance of succeeding. In general, investors like to have the next round led by somebody else so that they're not self-pricing the round. And so there's a weird dance that starts to happen where, you know, if we're on the board and you're on the board with the founders and you're thinking about the next round, as you know, as two shareholders in the company, we both want to raise the next round. And there's a little bit where the founder's looking at you saying, and how about you? Like, why don't you lead the next round? And but the reality is a priced round from somebody else is much stronger in the eyes of the market, if that's what you can pull off. And so that's in general what we do. And it's difficult because there is a dance to find the lead. And I think, you know, we've all had experiences where we've been raising around, we could have been at it for a year. We might have 20 people who have said, I'll invest when you find a lead, right? And so you've got this sort of build up inside the pipe, and it's like, can one of you just lead this round, for God's sake? And then as soon as somebody leads, the whole thing just happens really, really, really quickly. So there's an art to finding a lead, and I don't quite know what the formula is yet after all these years, but there's certainly a job to be done there. And just the other thing I've seen investors do a lot more of now is actually the opposite of that, which is just preempting around and just sort of causing interest in the company, and also often to actually increase their own stake in the company, you know, saying, I've got confidence in what you're doing. I would like to own a little bit more. Here's $5 million. And then that starts around and gets everybody else enthusiastic about it. So it's kind of, it started with that weakness because it was internally priced. But on the other hand, it causes momentum. So there's different ways of doing it.
Yeah, I was just thinking for seed, obviously there's not a lot of proof yet, but you've just got to believe all the main things that you see in the market all of the time. But you're focused on problem, opportunity, or solution, the competitors, you know, the opportunity, market size. And then as you move towards Series A, it's more about execution, proof in the pudding. Will your current investors come with you? You know, and I totally agree with Phil, like, you know, we've got one business that's raising now, and it really wasn't being planned to raise until next year, but it's getting a lot of external interest. And so what you've got to say is it's really hard to turn away money always. You should just don't do it. Just take the money when it's there. And that's forcing us into a round. Now, we might end up pricing it because the lead investor doesn't, you know, want to end up doing all of, you know, the shareholders agreements and all the legals and things like that. But from my point of view, at least, it's validated by the market, you know, so we're having enough investors coming along, putting in enough money to sort of price the round where it's at. Of course, it'd be lovely to have someone else come in and just, you know, slam a term sheet down, but you know, this is the real world. It doesn't always behave like a textbook, unfortunately. But in early stage tech, we're the same. We speak to founders for years and years before we invest in them. But I really, truly wish there was more competition in early stage deep tech. It's an area that, you know, needs more money into it, really.
So follow-on investments, we tend to invest on certain investment principles, and we have a list of statements which we rate out of 7, 1 being low conviction, 7 being high conviction. I thought I might share some with you guys in case it's useful. But we tend to look at broad buckets around founder, team, product, market, sales, traction, and funding. So around founders, for example, there are statements like, the founders have shown great velocity of progress since we invested in the last round, or the founders have unhatched since we last invested. And unhatched really means around their clarity of thought, their own conviction, and their own product roadmap, being able to clearly articulate where they're going, and hiring great people. Other statements are founders' ambition has increased since we last invested, and we've developed a strong relationship with the founders since we last invested. And also around the team, the founders have made great hiring decisions since we last invested. And Series A in particular, it's really important because you're going from being kind of a chess piece on the chessboard, doing everything yourself, to being the chess master, where you're really hiring different resources and putting them in place because you're not going to be scaling on your own. And so showing the ability to make great hires and putting the right people in place is such a incredible metric that we look at. And also part of that is the company culture has improved since we last invested as well. And in our Slack channel, we actually we scrape data from Glassdoor of all of our portfolio companies and track them, and would ping them every time we see like a 1 out of 5 from Glassdoor or 5 out of 5, just to keep that pulse check from our portfolio companies. For product, we look at statements like, I love the product roadmap and the milestones for this round. There's evidence of strong customer love. The product is 10 times better than status quo. The team can build the product. And to Ellen's point, that I believe the tech risk will be mitigated with this round, and broad things in market around the market opportunity has improved since last round, or the sales cycles have improved since we last invested. And also looking at the traction, this company has shown exceptional traction. And also when we make investments, whether it's pre-seed, seed, or Series A, we tend to have our own internal metric of what the forecast would be for the key metric. So whether it's ARR or numbers of LOI or whatever it is, and we tend to forecast that into the next year and the following year. And so we're able to look back and see, did the companies meet our forecast or their own forecast? And that gives us kind of conviction to follow on with larger check sizes as well. And lastly is around funding. So, is this the right size of fundraise, and that will get the companies to where they want to go? Is the valuation fair? Do we own enough equity, and all that stuff? So really calibrating it against the previous round that we've invested in our level of conviction as well.
Tip, can I ask a question? How many seed investments do you usually follow onto as a percentage? Is it like 80% or is it half? When you're taking big swings, how do they progress through your pipe?
Yeah, I don't have the exact number, but what we do calibrate it on is, so we have an early stage fund and a follow-on fund. And with early stage fund, we tend to invest pre-seed, seed, Series A. And to go from pre-seed to seed or seed to Series A will tend to come from the early stage fund. And that's the competition between all the companies in that fund and how much money we have left. And so we do budgeting around how much should we calibrate and reserve for certain investments. And so getting pre-seed to seed is pretty easy. Seed to Series A can be easy sometimes, depending on how much money we have left. But generally from Series A to B, and B onwards, it gets really competitive because you're competing with 70 other portfolio companies like the Canva, the Zoox, Safety Culture, all those guys that are knocking it out of the park. And so the opportunity cost becomes a lot bigger, to invest $5 million in this company versus $20 million in this other company that's doing really well. So it becomes more difficult to get follow-on funding kind of Series A and above.
So we have cash flow issues too. So I think that's always good to say.
Awesome. What I might do is, given just where we're at in the time, and I think I feel like this is another 3-hour conversation easily. If anybody can stomach 3 hours on Zoom, I can see people's reactions. But what I might do is just invite Rachel and Adina back in, because there's probably an opportunity for us to dive a bit deeper and have a breakout so that everybody else can participate.
Yeah, I think so,
as well.
Colette. It's been fantastic eavesdropping on this conversation, and you're right, we could hear this for a few more hours. I know there are some people that might have to head off, but for those that want to stay around, we're going to break into smaller groups now, so you can ask your questions directly and actually have a discussion and meet other founders as well as talking to the investors. So just be patient and we will be prompted into smaller groups. Thank you to those that actually have to leave. Thank you. And recordings of this and other circles will be available on the Tech23 website. But for now, I hope I see you in a meeting room in a minute. If you get lost or you don't like your room, come back to the main room and my colleague Caroline will be able to help you. Thank you.